Dividend stocks are a great long-term retirement strategy. You can build up a portfolio of investments that pay you reliable, growing dividend income while maintaining and growing your total market value. But what if you don't have much time left to invest or want to start living off dividends fast? How do you get closer to retirement level income earlier? Well, you'd have to focus on buying higher yield stocks. That means you get more dividends now for what you pay. It seems simple, but this process leaves many people to make big mistakes. First, they may buy a company that's cheap for a reason where their business and earning power is deteriorating. Often that means the value of your investment will decay, with losses often exceeding what you get paid in dividends. Second, they may buy a company which is at a severe risk of a dividend cut. In that case, your only reason for buying the stock has been destroyed. Often, you'll see both of these things happen. Today, I went searching for some quality dividend stocks which are currently trading at a high yield. I screened for US stocks yielding over 6% and selected 5 that were actually worth sharing with you guys. For example, we have the Altria Group, ticker symbol MO, a very high yield dividend growth stock, and in its history, it's actually delivered a strong total return, especially over the long term, as the company's total return is 10,000% since 1990. And today you can get a 7.83% starting dividend yield. But before I dive into that and my full list, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using the best stock research tool for dividend investors, which is available at dividenddata.com. This gives you all the tools to avoid dividend cuts and actually find quality businesses that will grow into the future. The tool more than pays for itself, so if you're interested, the link is in the description and pinned comment of the video. So let's start with the Altria Group, ticker symbol MO. For context, I own this stock in my personal dividend growth portfolio. I've been buying it since 2020, with the majority of my position purchased in 2022 through early 2024. My total return is 43.39%, and a lot of that comes from dividend reinvestment. I've earned 84 shares from reinvesting dividends, and that's because the stock pays me $2,200 a year in dividend income. My dividend yield on an initial cost basis was 9.51%, and from reinvesting dividends over those years, that has been boosted to 11.23% on my initial investment. So that means for every $100 I initially invested in the stock, I am getting paid every year $11.23. And I'm a young investor more focused on long-term dividend growth and total return. So I'm not taking this out as cash. I am reinvesting all my dividends to get more shares into Altria. And I actually have this pretty great compounding effect going on where all my dividends go to buy more stocks, which increase my future dividend income. And that allows me to buy even more shares in the future. And that creates a virtuous cycle us dividend investors refer to as the dividend snowball. And actually this January, I'm going to get a $559 dividend from the Altria Group. At today's stock price, that would reinvest to get me around 10.7 more shares of the company. And considering the current annual dividend is $4.08, you could think of that as my dividends are buying me another $43 of annual dividend income. You also have to remember in this scenario, you're buying a stock which has its own value as well, and that's liquid, so if there was some crazy emergency, you could sell it. But the big thing with Altria is that they actually grow their dividend payment on an annual basis on top of that very high starting yield. And this company is actually a dividend king, meaning they have over 50 years of consecutive dividend increases. It may not seem like it in these charts, but these dividend increases are actually from spinouts. For example, Altria used to own Kraft Foods and Philip Morris International, and those were both spun out, and those became separate companies with their own dividend payments. But prior to that, and since then, Altria has increased their dividend every single year. The most recent dividend increase was 4.08%, and the 5-year compound annual growth rate is around 5%. This is a quarterly dividend payment, so that means you get it 4 times a year. And this dividend is actually sustainable too, with a 74% free cash flow payout ratio as of fiscal 2023. And you have to keep in mind this is a very mature business, so they're at the phase where they pay out almost all of their profits as dividends. So this high payout ratio based on free cash flow is by design. However, if you looked at the payout ratio based on net income, which would be GAAP earnings per share, their payout ratio was shown to be unsustainable from 2019 through 2022. However, that was not an accurate look at their business. With GAAP accounting, you have to include losses and gains on any investments you made, and the Altria had a massive failed acquisition in Juul, so they had to continually write down the value of that investment every single year, so it hurt their GAAP earnings per share. But you have to keep in mind that was only on paper. There was not any actually cash lost in that time. The company continued to generate lots of cash, and it more than supported their dividend payment. It's for this reason why I think it's so important to look at payout ratio based on free cash flow, and that's why I specifically built this into dividenddata.com, and it's not available on the vast majority of investment websites. People were looking at Altria's net income and saying their earnings were bad and the dividends unsustainable, but I knew that was only due to those write-downs, and the company continued to generate very high free cash flow in that time. And because of that, I was buying Altria stock when it was in the 9% dividend yields for years. So I got a fantastic price on this company. However, those investment write-downs are now in the rearview mirror, and they're completely disconnected from Juul for the most part. So you can see that their net income per share has actually been improving recently. And I think that's one of the main reasons why a lot more investors have been buying Altria stock and the price has gone up in the past year. They started to realize that it's so cheap and that the dividend is not at risk of being cut anytime soon. In fact, it will likely continue growing over time. On top of that, Altria continues to repurchase shares, adding to the capital return to shareholders. So if I was someone looking to retire fast with their dividend income, I would consider a stock like the Altria Group. It's my #1 dividend payer and #3 stock in my dividend growth portfolio. But as I mentioned earlier, my goal right now isn't to retire anytime soon. I'm focused on long-term total return. I'm pretty young and have decades left of investing. But if I wanted to, I really could boost my dividend income by focusing even more on these high-yielding stocks. And Altria is one where the total return's not bad either. Over the past year, you've had a 34.97% total return, 56.62% over the past 5 years, 94.7% over the past 10 years, and over 10,000% since 1990. And I do think the next 5 to 10 years are going to have pretty good total return for Altria. Their last decade was really ruined by an overvaluation in 2017 because people were all hyped up about that Juul acquisition. And to give you an idea in terms of valuation, Altria stock was trading at a 3.2% dividend yield at that time. And considering this is a low growth business, that is not a good buy price at all for Altria. So that definitely hurt their total return over the past decade on paper, but that's not the real world. The real world is a reliable, slow growing business with a reliable, slow-growing dividend. And what matters is what you paid, not what people paid in 2017. For stock number 2, I have MPLX. This is a midstream oil and gas company, and it is a limited partnership, so similar to EPD, which is a stock I own. You'll get a K1 in the mail, so it changes your taxes a little bit. People don't like that. And it also means you don't get the lower qualified dividend tax rate. But there are some other advantages with that as well, and you can go look into that if you're interested. But what I like about this stock is they have a 7.89% starting dividend yield today, and that got as high as 17% in 2020 and 32% during the peak of the pandemic crash. Imagine buying the stock at any time during 2020. I wish I had that on my radar. And the reason why that's great is this is a long-term dividend growth stock. For a while, they were increasing it every single dividend payment, and really since 2021 or 2022, they started increasing it only on an annual basis. But these are big increases. The most recent increase was 12.53%. So that's pretty nuts. A 7.89% yield with a 12% increase. This is also a quarterly dividend payer. So like Altria, you'll get it 4 times a year. They've been paying the dividend since 2013, so there is a very strong history of consistent dividend payments. The payout ratio is sustainable at 73% based on free cash flow and 83% based on net income. This is a stock I discovered recently and I have it on my watch list. And like most things, the total return depends on when you bought it. The 1-year total return's 41%, the 3-year total return's 104.28%, the 5-year total returns 205%. However, the stock was overvalued back in 2015, so if you bought it then, the 10-year total return would only be 56%. So again, I'm just bringing up the price you pay for a stock matters a lot. There is a big difference between buying the stock now or even over the last 5 years than buying back in 2015. Leave a comment below if you want a full stock review video on MPLX. For stock number 3, I have Verizon, ticker symbol VZ. You can buy that for a current dividend yield of 6.84%. 8.6%, and that got as high as 8.67% in fall 2023. A lot of dividend investors like this due to its consistent dividend payment that slowly grows over time. However, this is a very slow growth company. The 10-year compound annual growth rate of the dividend is 2.1%, and the most recent dividend increase was only 1.8%. And this is also a company where their stock price and earnings have been flat for basically decades. And if you bought Verizon stock from 2018 to like 2022, you lost a lot of money because the stock price has fallen. So with this kind of stock, the overwhelming amount of your return is going to come from the dividend. And I still included it on this list because if you're focused on just that dividend income, this will be reliable and continue to slowly grow. And you have a 6.84% starting dividend yield. The dividend is sustainable too, with a payout ratio based on free cash flow of 58% in fiscal 2023. The net income payout ratio is 94%, which was a little bit of an outlier. In prior years, this has been around 50%. Another big concern that weighs down Verizon's valuation is they have a lot of debt. This is true of all telecom companies. Verizon has $169.2 billion of net debt, and there's no doubt this hurts their valuation and multiple. But if you're looking for high dividends that are safe, Verizon's probably one of the better ones to look at. As I mentioned, the 5-year total return has not been good, or really the 10-year total return at 37%. But remember, you're buying Verizon stock today, not in the past decade. And I think there's quite a few reasons to believe that the stock price may slowly go up over time, and you can lock in a 6.8% dividend yield. For stock number 4, I have Realty Income, ticker symbol O. This company currently trades at a 6.01% dividend yield. And what some dividend investors go crazy about here is that this is a monthly dividend stock. And in fact, Realty Income even has trademarked the monthly dividend company. So it's what they're known for. So a lot of investors like this because it helps them better plan out their dividend income, having money come in every single month. So that can be especially useful if you're living off of dividend income and you don't like to budget off of your quarterly or annual or semi-annual dividends. But that's really a problem for once you're in that stage of actually living off the dividend income. This company continues to grow their dividend over time. The 10-year compound annual growth rate is 4.06%. This has slowed down a little bit with the 3-year CAGR at 2.31%. Another thing people like is they increase it slowly throughout the year. And it's pretty cool looking at this history. It's kind of a model of consistency over time. And the dividend is sustainable based on free cash flow. This is a REIT, so you can't look at net income for this one. The current payout ratio based on free cash flow is 71%, and this current 6% dividend yield is one of the highest in the past decade. In fact, it was its highest in October 2023 at 6.65%. And again, because of its recent poor stock performance, the total return over the past 5 years looks ugly at negative 6%. But again, I gotta keep reminding you this. You didn't buy the stock 5 years ago. You are looking at it to buy potentially now. So you have to be forward looking with that. Even with those poor past 5 years, the 10-year total return 72.79%, and since 1990 the stock has had a 3,945% total return. Let me know if you want an updated stock review on this company. It's a real estate company that primarily has triple net leases and a lot of local shopping centers and stuff like that. You can think CVS, 7-Eleven, Lowe's, Chipotle, etc. And it's a very diversified company. However, one of their top clients, Walgreens, has seen a ton of store closures over the past few years, and that's recently accelerated. So that's likely a large reason why the stock price has been down lately. But hey, maybe we need to dive into it, and it could be a buying opportunity for the stock. And then for stock number 5, I'm going to share LyondellBasell Industries. I don't know if I said that correctly. I've never heard of this company until recently. Someone commented it in a video that trades under the ticker symbol LYB. So as I mentioned, I saw this in a comment and I thought I'd dive into it. It also appeared on that stock screener search I mentioned earlier. And as I dove into it, it actually seems like a pretty interesting opportunity. The stock price is down a bunch recently, which is why the current dividend yield is up to 7.26%. And over the long term, this is a dividend growth stock. The 10-year compound annual growth rate of the dividend is 6.71%. It's a quarterly payer that continues to increase on an annual basis. The most recent dividend increase was 7.2%, and the one prior was 5%. And it is sustainable with a 47% free cash flow payout ratio. That's 76% based on net income. So with this recent fall in stock price, the current dividend yield is one of the highest in the past decade, excluding 2020. However, over the long term, the stock has seen pretty good returns. Since 2010, it's had a 611% 11% total return, and that's even after its recent fall in price. That said, I am not an expert on their business or really know much about it at all. From what I've seen, it's a chemicals and materials company, so this might be an interesting one to dive into and learn more about. So those are 5 high-yield dividend stocks that could help you retire early. But as I mentioned at the beginning of the video, there's a lot of potential risk if you just start chasing high-yield dividend stocks because you're like, I want my dividend income now. You could end up losing a lot of money and making mistakes. And we all like investing in dividend stocks because of its compounding nature and the income, but there's a lot more to investing than just looking at dividend yield. And it's why I built out all these tools on dividenddata.com to help myself and our community invest smarter. Things like a free cash flow payout ratio and all these key financial metrics that help you learn about an actual business. All the other factors that drive whether or not there will be a dividend cut, dividend growth, stock price appreciation, or stock price decline. So if you found this video to be interesting and want to try out these tools, please sign up at dividenddata.com. The link will be in the description and pinned comment of the video. If you sign up, we also have a community Discord server where you can chat with other people following a dividend investing strategy, some of which are close to retirement and getting a lot of dividend income. So thank you for watching. Leave a like and subscribe to the channel for future dividend stock content, and head over to dividenddata.com if you're interested. With that said, I'll see you in the next video.